Hello traders, Simon here, and today we are going to talk a little bit about trading during crisis. At this time in FTMO, we are seeing that the demand for trading is substantially increasing. Now, one might say that this is because everyone is at home and they have time to seek out those sweet trades, but we think that this is because of the huge volatility in the market. With this huge volatility, opportunities emerge. And with these opportunities, of course, there are players ready to seize them. Now, this doesn't apply for retail traders only, but for institutional players as well. During the last crisis, banks, hedge funds, and rating companies played a key role in starting it. The source of that crisis lied in subprime mortgages. To make the long story short, loans were not paid, Lehman Brothers fell, many banks had to be bailed out by Fed, and liquidity froze because banks didn't lend any money. And hence it was called the 2008 financial crisis. Now, of course, this wasn't the only financial crisis in the history. For example, to name a few, there was the big market crash after dot-com bubble or the Great Depression after Wall Street crash of 1929. Now, the most important thing for any investor/trader is the source of the crisis and its expected influence on instruments. In 2008, financial institutions were this source, and therefore investing in these financial institutions could either make you a lot of money after the whole crisis was over, or it could straight out ruin your investment if it was Lehman Brothers. So what is the source of the current crisis? Well, unfortunately, we cannot point finger to a single institution that would be responsible, since the source is the spread of the coronavirus. The businesses are not closing because they lack liquidity like in 2008, but because they are fearful of spreading the disease. This doesn't hurt the big players with huge market share as much as small and medium retail businesses. Since this is the case, I would highly recommend looking at what policies will each government implement to help these small businesses, as that could be the main driver behind growth or fall of indices. If you are more of a stock picker, things might get even more complicated. For example, if you are into trading airlines, you can buy them at a nice discount, but you are risking that they will go bankrupt before countries are ready to open their borders. If you are more conservative, it also might be a good idea to avoid catching a falling knife and rather wait for signals of recovery and trend reversal, and that is the case for all markets. Since the daily range on most instruments has increased, it makes sense to make your positions smaller and to be aware of those slippages that can happen during the market open and during the market close. Also, if you are trading indices, remember that it is way more dangerous now to hold your positions outside of regular trading hours, since gaps might happen. One thing that you could notice is that we have recently hit a limit up and limit down on the American market. Limit up and limit down are the maximum amounts that the price of an index or commodity can move in a single session. Now, we have seen some really huge moves these days, and it is not out of question that this can happen again. Today, the only certainty is that everything is uncertain. So the key is to stay informed and to protect your capital. So as always, trade safe.